how does the risk-free rate enter the mean variance optimization? Let's consider an example where we've got 5 years of historical data, say from January 1995 to December 1999. We've got 5 asset classes, and we've got a risk-free rate. Usually what we do, and perhaps what we've been taught to do via the standard textbooks in finance, is to run the mean variance frontier program based upon the 5 risky assets. We get a curve. We have the risk-free rate, and the usual strategy is to draw a line from the risk-free rate that touches the frontier at a particular point that we call the tangency point. And this actually represents the best possible reward to risk trade-off. It's the so-called Sharpe measure. And that portfolio of risky assets is the portfolio that's optimal, that we can lever up and down to achieve the level of expected return and volatility that we actually want. But there's a problem. And the problem is the following. The risk-free rate, if we measure it with a 30-day Treasury bill return, as people usually do, does not have zero volatility. When you draw that line from the risk-free rate to the tangency point, that assumes that the volatility of the risk-free rate is zero. And if the volatility of the risk-free rate is zero, that implies that the correlation of the risk-free rate and the risky assets is also zero. That's how we get a line mathematically. But the risk-free rate is not risk-free. It changes. Look at 5 years of data for the 30-day Treasury bill rate. That rate changes. It has a standard deviation. And it's true that the standard deviation is small, compared especially to equities, but it's not zero. And what's also true is that the correlation between the risk-free rate or an interest rate and equity returns is not zero. If rates go up, that's bad news for equities. Rates go down, that's good news. Most people understand that the correlation between the rate and the return on equities is negative. It is also negative for the return on most fixed income instruments. But the usual sort of analysis that we see, we draw a line to some point, say something about the Sharpe measure, and this makes the counterfactual assumption that the risk-free rate has zero volatility and has zero correlation with equity returns or other asset returns. Indeed, if we're going to do this analysis over longer horizons for strategic asset allocation purposes, then we really have 2 choices here. We treat the risk-free rate as just a regular asset. We add it as a 6th asset in our optimization. We let it have correlation with the other assets. We use a volatility that's not zero. And then the efficient frontier represents the best possible trade-offs, the maximum expected returns for levels of volatility, in a way that's kind of consistent with the underlying assumptions and the underlying reality of the situation, that the risk-free rate is risky, measured over long horizons.